This week on the Wealthy Pilots podcast, the Fed has cut the rates. What does it mean? Let's bring Scott in and talk about it this week. Let's get it started.
We've got some turbulence up ahead. Reach out to the pilot's planner.
Hey, everybody, welcome into the podcast. Thanks for hanging out with Scott and I here on the Wealthy Pilots podcast as we talk investing, finance, and retirement. What's going on, brother? How are you this week?
Mark, I've never been better now that I can see you dressed in uniform with your pilot's planner shirt while I'm out of uniform.
That's right. Come on, squad leader. What are you doing?
I know,
You're
right?
killing me. You're killing me. How you doing, man? You doing all right?
Good. Really good.
Good.
Yeah. How about you?
Doing good. Today we are taping this actually on Wednesday, September the 18th. I am 2 days removed from being 1 year older. Yay. But more importantly to this podcast, the Feds cut the rate today as expected. Yep. However, Scott, they cut it 50 basis points. Half a rate cut, half a percentage cut versus the expected quarter. So I want to talk about that a little bit.
Yeah, it's very interesting. I had actually a handful of clients reaching out and texting like, "Oh, what did you think about the half of a point instead of quarter point?"
Yeah.
And you know, it's always interesting when these things are going on in this time of year, right? As we got 47 days until a presidential election,
Something like that. Yeah.
And so it makes you wonder, are they trying to boost the tailwinds for a specific reason, or is the data just giving the Fed enough, giving Jerome Powell up there
well, I mean, they said they were going to, it was scheduled for this date for a while, and they've been alluding to it that they were going to cut. So I feel like they got pressured though into going higher than the 25, than the quarter point. I think that was the expected number.
The quarter point was the long time expected. And again, I think, what's driving those pressures could be internal, that they just think the data is good enough that, hey, it warrants a lower cut. Inflation's favorable enough, the employment data. But, when you look back at the last couple of months, I mean, a lot of the employment data and what have you, I mean, it's not like it was warranting. It's not like it was getting to the historic levels that we would expect to see rates coming down at any aggressive level at all.
Yeah, for sure. And it's interesting that you mentioned that, Scott, because I was just telling you, and I know you're a big fan, that I just got finished off doing an interview with former comptroller of the United States, David Walker, and we talked a little bit about this, and he talked about a few of those pieces, some of the pressures. He said personally he would have done a quarter point, but he feels like because they were late to the party with the initial hikes when they first started this is why they jumped ahead and went with the half point cut this go around. And he actually talked a lot about the employment as well. So you're spot on.
Yeah, I mean, and David Walker, for those who don't know, highly recommend Googling that gentleman, former comptroller. Nobody knows the U.S. finances better than that gentleman.
Yeah,
he understands the funding of Social Security, Medicare, Medicaid, all the social programs, the military, the impact of interest rates on the economy. He knows it extremely well. I'm actually very jealous of you that you got to talk to him. So we'll have to.
We're gonna work on that. See if we can get him on the pilot planner. Yeah.
But I mean, he's got incredible insight, and really a lot of what he talks about is even on the tax side. I know we're going to do an episode soon here on tax planning as well, but he's got a lot of insight on really like every dollar we borrow is just delayed tax increases to future people and future generations.
Yeah.
And so he understands with a great level of clarity and conviction that the more we borrow, the more rates are going to have to go up. It's just the math. And when I say rates there, I mean tax rates.
You're spot on again, man.
Yeah.
I mean, he was saying the same exact thing. He's like, right now we have a little time left because, we're borrowing against our own, reserve. He's like, but it's, that clock is running down, which we talk about often. You've got to get fiscally responsible, not only personally, clearly we need to as a country as well. But taxation is really going to be the key interest. So you're dead on.
Yep. Yeah, and I think, kind of segueing into like what probably a lot of the viewers or listeners really want to know is, what does interest rates mean to my money at the end of the day? And to my life. It matters, right? I mean, we saw, right now in the real estate side of the house, interest rates being higher has significantly impacted home sales and slowed that down. And what you're seeing out there is a ton of people that are like, I'm never leaving my 2.75 to 3.5% mortgage. I don't blame them. I wouldn't either. I'm recommending to clients all the time, don't even pay that sucker off. That's close to free money. But the real estate side of the house will start to pick up a little bit.
It does take a little time. Yep.
It does
takes
take a little
time
bit
to
of time.
trickle in. Mm-hmm.
But I think people will start to see that, okay, we've peaked out. So if I see a house I want, I'll buy it now with the hope and optimism that in 2 years I'll be able to refinance at a much lower rate. So I do think you'll see that even pick up, just because I think that the buyer sentiment is going to be more so that, okay, we've hit a top. I'm not going to go in at a 6.5% mortgage and then see rates go up and then I'm stuck in that thing forever. So I think you'll see more activity there as people just get more comfortable with maybe the risk of a current higher rate, knowing that, they're hopeful and optimistic they can finance at a lower rate, within the next couple of years.
Yeah, and I think that the Fed their goal is to be at an inflationary rate of about 2.5% or so. I think that's the stated rate from Chairman Powell.
Yeah.
And obviously the numbers have been coming down. And it was interesting again talking with Mr. Walker on some of that stuff. And he's like, look, they can claim the numbers are what the numbers are, but we were seeing true inflation of around 20+% on most of the things we actually consume. And while it's great that it's going down in the right way, they're still concerned that it's that they're playing around with it. So he's like, I wouldn't be surprised if they went another quarter point before the year ended as well. So we'll see.
Yeah, dude. I mean, they were talking 7-8% or whatever. As you know, I have 7. For those who've not watched like my bio video, I have 7 daughters. So if you have 7 kids, trust me, what we saw on the grocery bill was not an increase of 7%. It is not
or
even
9.
close.
Yeah, no, not even close. Yeah,
so,
for sure.
I mean, we go through a loaf of bread a day, and if a loaf of bread's up 50%, yeah, I mean that is hitting more than 7% of the budget.
You look remarkably fantastic for being inundated with that many daughters. So you're doing a good job.
Well, after your third one, you just really lower the expectations out of yourself and just find the happiness in life every day.
There you go. That's good. That's right. So all right, you touched a little bit on what it means. Especially if you're thinking about, obviously when they're cutting rates, right? People think, well, is this going to help me? How's this going to help me, right? Well, hopefully, if you're running credit card debt, that's one place. But again, it's going to take some time to get there. You're going to start to see those rates lower. But it doesn't necessarily mean that prices next week are going to be dropping left and right? So you need to be smart there as well and not just, kind of go, yay, the Fed cut rates and I can do whatever, right? You still want to have a good economic plan for yourself.
Yeah, obviously, this is the Wealthy Pilots podcast. None of them are getting wealthy by carrying 25% APR credit cards that are now 22% APR credit cards. So that's for sure.
Right.
But to your point, though, I mean, I think what does it really impact? Like, when I look out at the future, and then especially if I'm a retiring pilot here in the next few years, what do I really need to be looking at from a future income standpoint? And these interest rates have a lot to do with our folks who are within that 5 to 10 year window of retiring. So first of all, on the stock market side. Again, I know we've showed this graphic here probably a month to 2 months ago, but I would like the team to put it up again so they can see where in the 1970s, we had a mixed bag of good returns and bad returns within a year of the rates getting cut. Of when the rates cuts actually start, it's in the investor's mind right now that the market goes up every time. Yeah. I hear it all the time. When rates get cut, the market's going to take off. Now, if you look at the 30 and then the 180 and then the 9-month and the 12-month returns, you can see like back now in the 2000s, we've had a mixed bag. I mean, I'm looking at it right now. 2001, a year later, down 10%. 2007, down 22%. So there are some market analysts and there's some institutional investors that when they see the Fed cutting rates, they see that, okay, yeah, maybe inflation's under control, but maybe also the Fed is seeing warning signs out there that they're going to tip us into a recession. And that little bit of market uncertainty or economic uncertainty, drives this action and this negative action in the market sometimes. So,
well, to your point, so we're taping this again for folks that, obviously catching this. We're putting this out on Thursday, the 19th of September, but we're taping it on the 18th, the day that this just happened, about an hour later, actually. And The Dow has already jumped considerably in the first hour since then, to your point. But what happens as it starts to kind of bake in some of that stuff, right? And so that's an interesting way of thinking about it. You get that initial gratification, but what will it mean long term? And is there another problem that they're kind of trying to hedge against? Because their job is really to try to keep stable prices, right?
Right.
That is the point of the Fed, is to keep stable prices. And Mr. Walker pointed out something interesting. We're on the verge of apparently of a massive longshoreman strike that could be happening here soon. And that, if anything else, will change the economy faster than this Fed cut rate will.
Yeah,
right?
and that's where there's a lot of noise always in the economic data and what's going on in the market. The interest rate environment is one aspect of it.
Yes, sir.
What I will say, I mean, that's really, I'll say it when I talk about the market here, we're talking about equities, S&P 500 or the Dow, whatever index you're of choice. But on the fixed income or bond side, what I will say right now is there are great rates that you can go and lock in. We don't recommend typically a lot of like bond funds because they carry that interest rate risk in them. But if you're getting close to retirement right now and you want to go buy a bond that's going to pay you 6% over the next 10 years and just know that 10 years from now, that money's going to be almost doubled, you can go lock that in right now. And that's out there on the bond market. Ladder your future income out. That's what we call it. We call it a bond ladder where, I have my income for the next 12 months, then 12 to 24 months, and then 2 to 3 years and 3 to 4 years, and then we just kind of get that pool of money. And then we know it's going to grow based off of that coupon rate. Now, could the bond default? Yes. But typically if you're buying high quality bonds, you're able to mitigate that risk. But at the end of the day, the higher interest rates that are out there now are super favorable to lock in some of those bonds. And so that's something for some of our retired clients. Let's get it now while the rates are good.
Yeah.
And so maybe you even ladder out a couple of years more than we typically would for that reason.
Well, and of course, as always, folks, make sure before you take any action, you always see how it's going to affect your unique situation, right? So, anything you hear at our podcast or any others, you want to run that by your financial professional like Scott. And so if you need to, have those conversations, make sure you're reaching out to him. Get yourself onto his calendar. Go to thepilotsplanner.com. That's thepilotsplanner.com. And don't forget to check the show note details for links and all that good kind of stuff. We'll have everything down there for you. And subscribe to us on podcast on Apple and Spotify and YouTube as well. Scott, any final points before we go on the Fed cut today?
Yeah, again, I know we shared the screenshot here of what the rates have done historically, but it's important to remember that we're, from a current events perspective, we're in an election season. And I know that because the market's gone up, the economy's been teetering, it's an election season. I know, because I hear it all the time, there are a ton of people out there with a ton of cash sitting on the sidelines. I mean, cash ain't our friend. It might be paying 4% now after the rate cuts. It's going to go down as the rates come down too. So cash is not necessarily working for us. It might make us feel good, but we got to give our money and our investments a job. We need our short-term money, locking in at certain rates that we know we're going to need for the income in the future, and then let the other stuff grow long-term and not go so obsessed about what's going on in the here and now. The obsession over the here and now should be, what's my plan for the future? And then we get all the money working towards that plan, not obsessing over news headlines. So that would be my key takeaway is don't let the current headlines and the presidential election season, drive you to have a bunch of cash on the sidelines when that's not necessarily part of your plan. And we see it all the time. So get a plan, work the plan.
There you go. That's a great point. So we'll wrap it up right there. Go to thepilotsplanner.com. That's thepilotsplanner.com. And don't forget to subscribe to us here on the Wealthy Pilots Podcast with Scott Osborn. We'll see you next time.
See ya.
Is your 401k working as hard as you are? Let's find out at thepilotsplanner.com to get started with your free full thrust 401k toolkit. Come see what a good financial co-pilot can do to help make sure your retirement is ready to take flight. Visit us at thepilotsplanner.com. That's thepilotsplanner.com.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.